appreciate your time, and we promise to bring you value like we do every week through our More Momentum calls, which is partnered with Sales Mastery, our flagship event. I like to say that Momentum Builder is the community, and Sales Mastery is where we gather. So all year long, we learn, we train, we get better at our craft. And today we have Peter Zevenberger with us, and he is going to help us with the younger buyers in our market today. I think we'll talk a little bit about the American dream. We'll talk a little bit about, is it dead? Is it real? You're talking to younger buyers today. I think it's still alive, alive and well. Is it less attainable? Maybe. But if that's true, that it's less attainable, then they need us more than ever to help them attain it. And that means that the dream is even bigger than it's ever been if it becomes more distanced. Because when something's too easy, then there's not that big a reward behind it. If something's seemingly unattainable and then you get it, it's that much more rewarding. So, Peter, I give the floor to you. Tell us a little bit about yourself, how long you've been with Neo Home Loans. I had dinner with Ryan Grant a couple of days ago. He's a good friend of ours and a friend of Momentum Builders for many, many years, speaker on our stage and influential in the direction of our company. So he's a great leader, and I'm glad to have you on.
Yeah, Ryan's a fantastic guy. In fact, when I was looking for a new home, Neo rises to the top of the list just because I'd worked with Ryan previously and I was really impressed with kind of what he was doing with art of home ownership and some other things. And then as we talked more, it turns out Neo's vision really aligned with what I was looking to do and bring to clients. I've been in the mortgage origination and management space for over 20 years now. And I live in the Seattle area. So one of the more expensive uh, areas of the country.
Yeah.
And so this idea of home ownership is becoming like where I'm sitting right now, the median home price is $1.7 million.
Wow.
So like a starter home is legitimately $1 million.
Yeah.
And so that part of, okay, I have a really good job, like you define really good however you like, but if it's paying $200,000 a year, you're still in a situation where the house will cost 5 times what you make. But more often, somebody's making $100,000 a year. And as I've played the challenge of first time home buyer kind of programs and such has been many of them come with income caps. And so you go, okay, well, if you're making the median income, which is often around here been 90,000, it's up to 120 now. But 120, and now I'm financing, $900,000 to buy that first time home. Like it doesn't compute. Like one caps out. So even if we don't have an income cap, you just look at what the financing costs of that home is, and it makes it seemingly unattainable.
Yeah, I'll tell you that about 6 months ago, I did that analysis on the people that we were having apply through our mortgage practice. And I said to myself, if you don't make $250,000 or more, you cannot
Right.
buy in Santa Clarita, period. End of story. Like, family
Yep.
income somehow needs to exceed $250,000 a year to buy a starter home. A starter home here is about 800,000. So you're looking at a similar market. The
Right.
one thing that I think is dissimilar is that you can buy a really nice house for 1.3. So you get escalation quickly as
Yeah.
for value, but the bottom is still very hard to get into. Uh,
Right.
and so I came to that realization earlier this year that if you're not making $250,000, you ain't buying a house. And condos are not that much cheaper right now. And so that's the reality that we're up against, and that's what I think the challenge is. And I'd love to hear how you're helping to overcome that. Yes, Troy says
So
250 a paycheck in SoCal is just living day to day. Totally.
right. And so I I've developed a lot of my business with financial advisors. So we're having this conversation. This has been an ongoing thing for probably the last 3 or 4 years. I've been working on this, and so I'm taking a contrarian point of view, which is parents of future homeowners. Part of what I believe is the American dream is there's a few parts of it, right? One of it is home ownership. Another part is I want my family to live somewhere near by me. Like I get in the today's society, people do move. And, maybe grandma and grandpa live in a few states over, but there's plenty of families. I grew up like the analogy I think it was, or the story I think it was, what was the triangle between my parents' house, my grandparents' house, and my great grandparents' house? And if I drove all that growing up, that would have taken 25 minutes to complete the triangle. And that's part of the American dream.
Yeah.
And
Say that, that's you're talking about something that's so important because I can give you some stats because I have a little bit of data on that on our radio show when Don and I did the radio show, the AM talk show. One of our regular guests was a college planner. And so, not dissimilar to what you're discussing, even though college can be seemingly temporary, it could end up determining where they live permanently.
right,
And so, the general radius, there's a line in college planning that they don't exceed. They call it the 150-mile umbilical cord. And they said that that's the perimeter within what people want to live in of their children. And so if you think of me, my lifestyle, my daughter, I wanted my daughter to be close, but if she wanted to be out of state, that would have been fine. And she chose Long Beach, which is an hour and a half away. So that's that triangle that you're talking about may have expanded due to necessity, but that doesn't mean that the desire isn't to keep it closer.
right. And so, I mean, we've seen it with clients where the kid, so in my area, if you drive 3 hours north, you can get in much more affordable territory. Great, great, great communities, but different. And so you have that situation where mom and dad, the parents of the future homeowner, have raised their family in the expensive area, and their kids are now leaving them to go buy in the affordable area. And now that parent has a choice of, do I want my retirement years to be around family and close to them, or so which means I need to either move up there. But the problem is that often the parent future homeowner is still taking care of their parents. So while they're not necessarily having multi-generation within the home, they have this push and pull happening at the same time. And so they're not able to leave the expensive area. So as I was talking to financial advisors, we have this massive wealth transfer that's going to be happening, is happening, and going to continue to be happening within the United States from the baby boomers down. And so this question of, should parents be starting to help their children buy homes now? And so this has become a part of I'm nearly done. I think by August, the book called Parents of Future Homeowners will be out. I'm writing that now. It's in final edits. If you go to my website, it's just pfh.ai. So it stands for Parents of Future Homeowners.ai. And we are helping financial planners clients. So this is my target market. Financial planners are helping their clients with their life plans and going, what do we want to do? And what you're finding often is those clients are saying, I want to help my kids now, not when I die. That money, if you help your child at the age of in their 20s, their growth potential of the help is way greater than if, you know, I'm almost 50. My parents, are still alive, and God willing, will be alive a long, long time more. So if I'm inheriting money in my 60s, I mean, that's nice. That's not gonna, if I'm waiting till then to help use that money to help buy a house, I've lost a lot of net worth building in that time.
Yeah, and so I think we need to touch base on that because if you think about families that are immigrants, as by your last name and my last name, we could say that we're immigrants.
I'm
Uh,
the grandson of an immigrant.
yeah, and my parents came here, so I'm the son of an immigrant. And so when you think about that, one thing that happened back, and I'll speak to Argentina and Italy because those are the two that I'm closest to, and Spain even. Those cultures, there was no opportunity or liquidity for kids to buy homes. So the traditional thing that would happen is you would inherit the family home, but you wouldn't sell it and go buy another one with the proceeds. That's crazy. That's American stuff, right? Like in Europe, the same home might be in the
Right.
household for 100 years or 200 years. It could be multi-generational housing. And it's only here that we have such a liquid market that you're like, well, I don't like that house. It's not where I want it. Let me sell it and buy something else and move something here. We have three kids, distribute the assets. Like that stuff doesn't happen. So what you're describing now is A, people are living longer. So the multi-generational, you can't put three generations necessarily in one home. And the
Right.
and the other thing that's happening is, like you said, people are starting to think about like how progressive thinkers are starting to think about like, how do I selfishly as a parent, I want to see the fruits of my labor
Hmm.
help my children now and not be able to see it when they benefit from it when I'm dead.
So there from there, Gino, is so I in the book I talk about how love conquers all. And so everyone can have a financial plan right up until their child walks in and says, "Hey, mom, dad, I can move in 4 blocks over, but I need some help." And mom, dad go, "Oh, man, if we can help you, we want to do it." And often financial advisor will tell you, yeah, they get the call on like Wednesday before the escrow needs the money on Friday, and the advisor's going to call on Wednesday and say, "Would you please wire a $500,000 to this escrow account?" And it's like, wait, what are we doing?
Yeah.
And so like that is where for me, like the business side, like how do you build the business with this concept is it's like, well, let me go meet with more financial advisors and help show them with proper planning. We can not only bring more value to their clients, but we could do a better job about being intentional on how that wealth gets transferred. Because the solution that way too many loan officers have is, well, just ask your parents for more and we'll put down more. And that, essentially will bridge the gap between what you qualify for and what the house costs with just mom and dad's money.
Yeah, but
Sometimes that is the solution, but that's not an intelligent solution.
no, I'm thinking about like, first of all, why would you put more money down? Let's not trap the investment into a house. A lot of times, if the asset is performing well where it is, and financial planners will love you for this conversation, say, hey, Mr. and Mrs. Mr. and Mrs. Smith, let's leave the money with your financial planner and let's take $1,000 a month revenue stream to subsidize the payment instead. Or if the parents are old enough and have enough equity, let's get a reverse mortgage to alleviate the payment that you're currently making, and let's take that
Right.
$3,000 that you're using today and give those $3,000 to your children now to help subsidize their life. And now you're passing down your inheritance while everybody's still alive.
Those are both examples that I have in the book. I have a client who I help them buy their retirement home. They call me about a year later and they say, "Hey, Peter, we want to help our daughter buy a house, and she's a school teacher. If we don't help her now, like home prices are just going to continue to escalate further than what her income is going to support." So she makes, we're just for today's conversation, say she makes about $100,000 a year, and we don't want her payment to be more than 30% of her income. So tell me how much loan, and we've already found the place. So how much loan can she afford? And we're going to bridge the difference. And so that answer to that was they were going to take $350,000 out of their IRA, their Roth IRA, extremely tax inefficient. I mean, and these folks are like 65. Like that should be the last dollars they're touching. So I went to them and said, "How about we do this? We'll take out far less. We ended up with approximately 100,000, just 20% down. Mom and dad co-signed on the loan, and they agreed with the financial planner. The daughter and the parents came together and came to an agreement and said, Mom and dad are going to subsidize the difference between 30% of your income going towards that housing payment, and the difference mom and dad will subsidize. And then each year, when mom and dad are doing their financial review with their advisor, one of the advisor's jobs is to review the daughter's W-2 and adjust the amount that she's paying based on as her income goes up, well, the payment will keep being 30%, right? This obviously is all just an agreement between them. There's not like some official thing with the bank. Um, what that's done for the advisor is creating relationship with the next generation. So one of the value adds of this is if you go interview the financial advisors you work with and ask them what their pull through from one generation to the next is, they struggle at this. As an industry, they struggle at this because usually by the time that wealth transfer is happening, the next generation is in their 40s, 50s, and 60s, and they already have a person.
That they found
So
on TikTok.
that yeah, that they found through whatever source.
But that
So
makes
here are what I'm
yeah.
there's a book called I think it's called the upstream model. It's essentially talks about getting upstream of wherever everybody else is fishing, if you will. And so by me helping the advisor get involved in the next generation's life in their 20s, I'm helping get them upstream. And so that is a fantastic way by which to create that relationship. Um, and I do some other ones. In fact, another example. If you like stories, I this is in the book. It's called The Retirement Builder, and the example in this one, I'll just give you a quick math, is it's $1 million home. Mom and dad showed him, said, we're going to give our son 25% down, so 250,000 for a down payment. I asked the son, are you contributing your 401k right now? Peter, just getting going in life, hasn't really been in the budget. I don't know, I'll get to that, was the answer. And so what we came up with, the quick story is, instead of doing 250 down, mom and dad did $100,000 down payment, which that gift goes against their lifetime, exemption. Then we said, you got the rest of you, or for the other $150,000, do a $23,000 a year gift. So we're doing it about $1,800 a month. And then their son can take and offset that by making a contribution to his 401k. So he's effectively funding his 401k.
Right.
It turns out the net present value that 10-year commitment of doing 23,000 for 10 years is 150 grand. So with the same $250,000, we're now acquiring the house and we're building out their 401k. So here's the cool part is, as advisors doing that, it's like, sure, that's going to deplete the assets under management for the advisor, but it's going to do it at a slower rate because that money is continuing to grow as they have that money over that 10-year period. And somewhere between, if you said that son happened to be 28 years old, somewhere between 28 and 38, I'm guessing he's getting a new job. And guess who now has a rollover for IRA coming?
100%.
And where would he put that? Well, with probably the team mom dad worked with that helped him get the house and helped make him rich. Because on that, 8.5, 9% growth in the IRA plus the conservative amount of appreciation on the home, by the time they're 40, they have a net worth of over $1 million. And so we showed them this plan, and then it gets even crazier from there because it's that same 250. That house when he's 68 will be worth about 3.9 million. So if you said, all right, thanks, mom and dad, for the 250, I just made my payments for 30 years. I own the house outright, and I have a net worth in my home of nearly $4 million. But by doing the 401k route that we did, if the son never contributed his 401k on his own from 28 to 38, they're funding it. They have a net worth of approximately 7 million bucks. And I believe that son will have his income will grow, his savings habits will be created. He'll see the benefit of it and continue to contribute to his 401k. When he's 68, he'll have a net worth of over 11 million bucks.
Yeah, Peter, I'm smiling because you speak the same language I do, right? So I'm a tax nerd in my spare time. Once I realized that for every dollar that you earn, you need to pay 50 cents in tax, approximately, once you get into the higher income brackets, I realized it was equally important to save on taxes as it was to make money. Like equally important, not
Right.
close to equally important, equally important. And when I learned that, and I started to bring value to our clients, as Ryan's always talking about, and Josh is always talking about, and obviously you're always talking about to your clients and these financial planners. You have a longevity in this business that others won't. So when people are thinking about being commoditized, when people are talking about being transactional and losing deals to rate, it's because they're not doing what you're doing. It's because they're playing in the wrong field, right? They're playing where everybody else is playing. What you've done is you've created an opportunity to work where nobody else is working, to work in a space that requires a certain level of knowledge about tax structuring, about estate planning, about avoiding taxation in the future, about how loans are not taxable, and funding retirement, the time value of money, and net present value, and all these other things that are not in the vernacular of a Rocket Mortgage loan officer. I'm sorry, they're just not,
Right.
right? And I mean, I'm sure there are some that understand the complexities, but the reality of the matter is when we talk about, like, when Dave Savage talks about the modern mortgage advisor, and you have to ask yourself this question if you're on this call: am I a modern mortgage advisor? What do I bring to the table more than the mortgage products that I provide? And Peter's clearly demonstrating that he does. He brings to the table an advanced planning strategic team to make sure that not only the people achieve their dreams, but that they do it in an efficient way. And he's giving value to the financial planners by letting them transition into a second generation of clients. And that's solving a problem for them. So he's bringing a tangible value to financial planners with a problem they have: see problem, fix problem. And then he's helping the consumer bridge the gap between where they want to be and the way the parents have been helping. I think, Peter, I think it's genius. You're definitely in the space that's not going to get commoditized at all. AI will not be able to replace you anytime soon. Maybe in 10 years they're going to replace all of us. Who knows? But for now, you've created a niche for yourself, which I do always advise people: niche, niche, niche if you can. And you've created a niche for yourself. That niche leads to regular transactions, though, too, doesn't it?
It does. No, the financial advisors have been, it's a funny thing. I remember when I was starting my career, just trying to find a financial advisor to speak with, was it's like, oh man, that'd be awesome to have a couple of those people in addition to real estate agents. Now I have more financial advisors referring business than I have real estate agents. And the difference between those referrals that you talked to, the level of trust because you think about it, people are putting typically millions of dollars with their advisors. And so if they say, hey, you should work with Peter, he's I've I have a guy, God bless him, he walks around. I've heard him introduce me, and then I'll be walking away and he'll say, hey, you want to know that guy? He's the best mortgage guy in the state. I don't know where he got that title, but sure, I'll
You'll
take it.
take it.
And but as a result, when the people call and say, "Hey, my advisor said I need to work," they didn't say I need to work or speak with you. What they say is I need to work with you. That's a game changing difference, and it's honestly a lot of fun. It makes because it what I've done is I've transitioned it from being the commodity that is mortgages to the relationship that can't be commoditized, which is why AI doesn't scare me. Like quite frankly, competition doesn't scare me because nobody can replicate that relationship I have. I'm not going to get every deal, but the deals that I get introduced to are because of relationship, and those are really hard to win away from me.
Yeah, and let's talk about that, right? So I think, obviously with us partnering with Todd Duncan, trust is everything.
Yeah,
And what you're talking about is a concept called the transfer of trust. And,
right.
and so the transfer of trust is more valuable depending on the level of trust of the person that's the transferor,
Hmm.
right? And so what you're describing is the level of trust in a financial advisor is 10x that of the level of trust in a realtor. And the problem, or not the problem, but the reason for that is the realtor doesn't have any binding agreement with the client and they're always afraid to lose them. Where the financial advisor already does have a binding agreement and already has their money in hand, they are a current client, not a prospect. And so when you're being referred a current client rather than a prospect, there's a completely different level of confidence in which they can refer you. So a real estate agent is always afraid to lose the deal. They can't afford for Peter to say 3 words wrong and then they lose the real estate transaction, right? That's the reality. And so that's where you get people to say, "Well, I give out 3 cards and let them decide." Or they say their grandpa wants to use Rocket, so we'll just let them
Well,
use.
Gino, and this works the other way as well, and in that financial advisors, the risk to them making a referral is actually way greater
Absolutely.
because they have this deep relationship. They effectively have an annuity in that business. Like, just do a good job for that client, and they pay, whatever, 10 to $150,000 a year for service. So just don't screw it up. The best thing, I used to work for a guy, he really good sales guy, and trainer, and he was the CEO of our company, and he used this great story to kind of tell this. And he was at his local club, had become good friends with a financial advisor, and they played basketball like every day at lunch. And finally one day he says, "Why haven't you ever referred me someone?" The guy goes, "You need to understand that my clients are like fine pieces of china. And once I get them, I polish them and I put them up in the china cabinet. And as long as I leave them there, they pay. And when you ask me to hand you a referral of one of my pieces of china, the the best you can do is give it back to me unbroken. But you might break it." And so that is the challenge that you have to overcome to become the trusted advisor, mortgage advisor to financial advisors. Is you have to get them to a spot where they're going, "I am willing to risk you breaking my plate because I see what you're bringing is greater than not doing it." And that's where the parents of future homeowners just so ties into, like in my market, it's not unusual. You go anywhere and start talking to people about their kids buying homes, and ask your clients, and they say things like, "How are my kids ever going to be able to buy a place?" And my clients, I smile at and say, "Well, I know exactly how. You're going to help them." And they go, "Well, geez, they're so expensive." And in the book, I have lots of ways, both organic, and so it's not always like, "Well, we just have a lot of money." There are things like, okay, the rent, say, let's just say, is $3,000 a month for a house, and the mortgage payment on the same house is going to be somewhere around $5,000 to $6,000 a month. The 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 new generation, it always feels weird to call them the kids because obviously they're adults, but
The new
they
generation of 32-year-olds. Yeah.
right, they can afford the $6,000 a month payment, but they don't have the down payment, and mom and dad don't have the money either. This I call the strength builder exercise, the financial strength building. You got to move in with mom and dad for a year. You pay them rent and the amount of the mortgage that you're going to be getting, the mortgage payment. So that's $6,000 a month in this example. At the end of the year, you have $72,000. That's 10% on a, like from where I live, you got to go a half an hour away and you can find a $720,000 house. So you're in the market, you're in the game.
Yeah, or
And
depending, maybe the parents don't have the money set aside, maybe it's trapped in a 401k, but maybe their income is sufficient. Maybe you take a HELOC in the name of the parents, and then the parents gift the money to the child, and now that doesn't affect the child's DTI, right? So now you got it as a
right.
gift on the child side with no DTI, and the parents can service the debt on their side to help them, or the kids, if they have sufficient income, they just didn't have the down, they can service it on their parents' side without affecting their
I mean,
DTIs.
there's lots of ways. I mean, like I had clients who were move up buyers, and in the pandemic era when everything's, 10 offers, escalating huge, all this stuff, nobody's taking the contingent. I had clients sell their house, and mom and dad had a house with a large lot, and the clients literally went, "We've always wanted an RV." So they bought an RV with some of the proceeds, lived next to mom and dad, saved money, and then that allowed them to not have to be contingent. So they were able to go make more aggressive offers because now they have all their cash. It was just one of those, I guess the term's house hack, but it's not always just okay, well, if I don't have rich parents, then it doesn't work. Like in that particular family's case, they had parents with a large yard. Like that worked. Like dad heard they were doing it, and he literally was like, I'll put in an RV pad because I think dad wanted a RV anyway. Like it all worked, right? And
Family
so
RV, yeah. So
right. And
I think you're identifying something that it's our job to find simple solutions to complex problems, right? And so to create clarity and a roadmap for people that don't can't see beyond 2 feet ahead of them because they're too tied up in what they see. It's our job to take a step back and say, okay, look, hey, I've seen this puzzle before. Here's some ways we could solve it. Do you have access to assets? Do you have access to equity? What are your current outlays? And so the thing that I have really, really been focused on for our team and our organization is spend more time with your clients. It's not about getting through
Yeah,
as
Gino,
fast
you hit
as
it
possible.
like so the tactical part of this is yeah, at Neo, we do something called a dreams and goals call. Like, and I love it because it's very high level. Like, I don't want to get into how many cents is on some, like, I focus in finance. If I was in this sense, I would have been in accounting. And so I want to know high level. I'm trying to identify what what your desires are, what's motivating you, what your fears are. I'm also looking out for roadblocks where it's like, okay, we're going to need to navigate around this, under this, over this. So things that might become issues later on, I'm trying to identify all those up front in a dreams and goals call. What I'm not doing is doing all the basic stuff that happens on the application. Like if somebody fills out the application, that's not identifying roadblocks. It might identify why they don't qualify, but the fact that my money is actually being held in a foreign bank account, like that doesn't show up on the application. It just says I have money, and but in a dreams and goals call, I recognize that. So what I've done then is expanded the dreams and goals call to actually now that's where my website, my landing page for parents of future homeowners, which is just pfh.ai. Um, it really is just for parents to schedule a consultation with me. And it usually starts with them. We bring their advisor in because one of the things parents struggle with is it's like, well, we like to help our kids, but we don't know how much help is helpful. We don't know what we can afford. We're afraid that maybe we start down this path and our kids come back and say, "Oh, mom and dad, maybe they had in mind helping like $50,000, and the kids come back and say they need a half a million." And it's like, oh, we have this misalignment. So how do we do this without hurting feelings? How do we navigate the fact that we have more than one child? What is fair? What is fair is something that gets discussed a lot. And so usually the way this starts is I end up with the parents. Perfect world, I get the advisor. Sometimes it's an advisor I don't even know, which is great because then they just get to watch all my my value happening. And then from there, this is another great part of this, is we start to identify what's important to mom and dad and what they're able to do and what their desires are. Then I ask them to introduce me to their prospective first time home buyer or their move up buy, like just their child. That's a heck of a referral when the parents are saying, "Hey, child, help! Like we've been thinking we might want to help you buy a house." Kids are going, "Really?" Like they often have no idea the level of wealth mom and dad have. It's another thing I think is unfortunate within our American culture. We don't talk about wealth. Um, Now I'm doing a dreams and goals call with the kid, and then from there we get the kid pre-approved. Just what can they do on that? Sometimes it turns out they don't even need help. Sometimes maybe they just need a little bit of a push,
Yeah.
right? And so it's like, hey, maybe you should take that $400,000 a year you're making and I don't know, do something with it, like build wealth. Um, and so we get them pre-approved, and now we take that information back to mom and dad, sometimes with kids on the call, often without. And now we get to start being creative on here's different way. Like if you give this much down payment, here's what that could help with. Here's, do you want to be on a loan with your child? I have one right now. They're like, yeah, we would co-sign, but we would prefer not to. We like our child to kind of fly independent with whatever size of loan they can qualify for, but we want to help. And in that conversation, we discovered it's like, oh, well, you have $12 million in investable assets. They're working for you right now. And you own that investment property over there that's worth $2 million and you have zero debt on it. Why don't we take a loan out against that? And so mom and dad effectively are getting their own loan. So they're not intermingling the cosign, like they're going to simplify their world. They're just going to go, that loan we took out and we're using the proceeds to help Junior get his house. But then Junior's going to have his own mortgage. He'll have his whole thing set up there. And so this like that only happened once. They don't have to keep trying to manage this going forward.
Yeah,
It was a great solution for that family.
I had a similar solution, and I don't originate at all, almost at all anymore. Just only when they're past clients or family members. And so I had a situation last week where the dad calls me and he's like, "Hey, I need money. I've got some bills, some taxes." And this is the eternal cash out family. Like every 2 years they need cash out. They always spend more than
Right.
they should. And I'm like, here we are again. You sold your big house, you downsized, you had no debts, and now you haven't paid for your insurance and taxes again. You're 66 years old, your business died. I'm like, can we talk about a reverse mortgage again? So like I've been talking to them about reverse forever. And they're like, oh, I don't know. And I said, and through that call, I discovered they said, well, I'm having this family problem. I said, well, what's that? He says, well, we gave our daughter $75,000 and now my son's angry because we never gave it to him. And I said, well, would you like to solve that problem? And they're like, yeah, I mean, we figured, just it's going to go away at some point when we die and they'll have to deal with it. I'm like, why? Why are you going to leave that kind of legacy behind? You have a problem now. We have the means to fix it today. And I go, and just so you know, if you die 10, 20 years from now, that $75,000 you're going to give him is not worth as much as the 75,000 that you gave her 3 years ago. It's already the 75,000 if you give it to him, it's going to be worth less.
Right.
And of course, then the real personal stuff comes out, and it's like, yeah, but he's just going to blow it. I don't really want to give it to him right now. I said, okay, well, it doesn't mean you have to give it to him physically so he can go buy a Ferrari. Like, you could find a way to give it to him invested, maybe buy a life insurance policy with a one-time payment. Like, there's a million different ways that you can give it to him without giving it to him now. Remove that family friction. We'll get you a reverse mortgage so you stop getting yourself in debt. Every single, let's stop doing loans that I got to charge you points on every 2 or 3 years. Let's just get rid of that cost, do one loan, and it's your forever loan for both of you. And it's funny how when you finally see someone, when you're actually solving real problems, not just can I get into a house or not, but solving like tension, that there's interfamily tension about these things, everybody just breathes a sigh of relief and they go, oh, I'm so glad that I found you. And then when you do solve problems like that, that's how referrals happen.
Let's show you an example, another reverse example. This one, the family had one child, state of Washington. So the death tax, there's a pickup in Washington. So the federal exemption is at whatever it is for a married couple of $12 million. But the Washington state death tax starts at 2 million. And with married couple, I think they get to double that up, but it's still like, and I'm not the tax expert by any means. But same thing, like mom, dad bought a house 30 years ago for 300,000. It's a view property. It's worth easily probably $4 million today. And then they have assets that are greater. Now, the house will be exempted from some of that death tax, but they have assets that are going to go greater than the taxable amount. And so there's going to be a death tax due. The down payment portion was it's like, well, let's put a reverse mortgage on the house and use that as a down payment for your son. And then because I asked him, I go, do you want to live in your parents in the house you grew up in? He goes, no, that's not my style. I don't want to live in that part of town. I want to be over in this cooler area. All right, cool. Uh, I'm like, well, then essentially we're going to let your inheritance make the payment for you.
Right.
We're effectively for him financing 100% of his property because the down payment is the reverse portion, and then the equity within the home's paying that payment, right? Um, and then that also got them into, okay, what are some other trust vehicles and things we can do on the assets? Because now we don't need those necessarily. Like it just brought a lot of clarity to questions they were having, and that was a great solution for that family.
Yeah. No, I think, look, at the end of the day, we're talking about bringing solutions to people, creative solutions to people that they haven't thought about to the problems that they're trying to solve. It allows us to move generational wealth while everybody's still alive, which allows people to enjoy it. I mean, listen, grandparents want to see their grandkids thrive and grow in a nice, stable household, and they know they can provide that during their lives. That's amazing. Again, I think, and you're not susceptible to. I talk about fishing a lot when it relates to clients. You're fishing in a different pond. You're the guy that's all by himself in a pond full of fish, right? When you're talking to financial planners, and people talk about talking to financial planners as a business source, but if you don't have the education to talk to financial planners, you have no business doing that. So I always have to say, like, you can't just go to a financial planner and be like, send me your refis. But,
Right.
that's not
No,
it. You have to solve complex problems, and I love the way you described it, and be able to earn their trust in a way that allows them to lend you their china and give it back even shinier than they could have polished it themselves.
I would say so. A couple of like if mortgage advisors are listening to this, going, okay, how do I do some of that? Someone's got to read like crazy. Um, if one of the books I took to my financial advisors, I do some networking things with with different folks, and so financial advisors, I did a big push on the book called Die with Zero.
Yeah.
Um, it, because and within that book, it just points out a lot of principles around, what are you doing this all for? Like what is once you've achieved your hierarchy of needs with respect to finances, that excess capital, what makes you happy with it? And so that is a good book, I think, because there's a common language between advisors and knowing that language. And so because that they'll look at that going, okay, if you understand at least that bit, now that's changing it's not just, well, what's your rate? It's like, no, I'm here to help people with their plan. The story I use, it's in the book, and I use it a lot with clients when we're having the initial call with the parents of future homeowners, is I ask them to picture in their mind's eye a Thanksgiving table. And that Thanksgiving table, what is of more value to you? There's no wrong answer. It's kind of the spectrum. It helps me learn who they are. Do you really value the plate in front of you and all the food on it, and you're looking to put more and more food on your plate? Or do you take value in the food at each plate around the table? And if the parents, and generally, if they're speaking to me at this point about maybe helping their kids, that they answer towards the side of the spectrum that says the whole table. So then from there, it's kind of a die with zero like vision exercise we're doing where I'm going, well, let's imagine we help all of your kids. You have three kids. And what if we could give them this scoop of house on each one of their plates? And now 10 years later, your kids are all in their late 30s. They've now been homeowners, each of them for about a decade. That entire Thanksgiving table's value has increased exponentially, as opposed to if the parents had just kept all the money in their investment account. And it's like, well, that would have had some growth, but the leverage effect of helping each one of their kids become a homeowner, it's like this will be generationally, it will change the game for a family who's already done well. It's like, how do I do better? And you talk about it, it's on taxes. As you work with financial advisors, the name of the game for them is tax planning. Like, how do we recognize it? How do we get around? How do we avoid it? It's tax avoidance because trying to outperform the next advisor, it's like good luck. Like, not many of them are good at that, or that much better. But the tax avoidance, not only can you be smarter, the numbers are huge. Like if the death tax is 50%, it's like, yeah, well, if we can avoid that, it's like, I don't care if you got 9%, 10%, 11, 12% returns. Those are all rounding errors to that. I avoided this massive tax. So that's where a lot of advisors like that discussion.
Yeah, no, I think tax avoidance is something near and dear to my heart. And I think it's something that's completely a blind spot for most families. It's even a blind spot in the loan industry. Even loan officers that have a significant income haven't found ways to avoid taxes in a meaningful way, being that most of us are paid with a W-2, and you have to find a way to avoid those taxes. There are strategies out there, and your CPA does not have them. Let me tell you. CPAs are form fillers. Sorry if anybody's a CPA on the call, but they're form fillers, and they basically only tell you if you're doing something wrong, and they don't usually come up with very creative ideas on how to avoid taxation. And so I found that there's this whole other world of people that are tax strategists. And so if you could bring that tax strategist in, whether it be a financial planner or not, sometimes the financial planner is not either, but you could have this third party come in as a tax strategist to consult everybody, and then you could even bring that person in and help them save. You could even create additional revenue on an annual basis by reducing their tax liability on an annual basis. So again, I think yes, that's the X factor, is using tax strategy to create additional income streams or additional long-term assets is the secret sauce to long-term success for many, many professionals.
Agreed.
Yeah. So, any final words before we go to a little bit of housekeeping that we have here that you want to leave people with, Peter? I think today's been very valuable. It tells people that they need to have a niche, it tells people that they have to have a level of expertise that's above and beyond that of their peers. I can clearly see that you have that you have a niche, you have a level of knowledge in a certain sector that gives you specific knowledge so you can build new relationships in a pool that other people don't fish. So I think you're really onto something, and I want to make sure we share how to replicate that a little bit.
Well, Gino, the book, like it says, still in production, but as soon as it gets to that advanced copy, I will let your team know so that anyone that would like to read it and learn more, I think it's the beginning steps of becoming a advisor that can do this for your, everyone's community.
All right. Well, we'll make sure to share that. And can are you going to be committed that you'll have that done before Sales Mastery?
This
October
is
14th through the 17th. Can we pull that off?
it will be done before then.
Yes. Okay. Well, then maybe it could be one of our value add gifts that we can put into our value package and proposition, and share with our peers. The reality of Momentum Builder and Sales Mastery is not everybody will win, but those in our community will. And so thank you for being a part of that. Super appreciate all the Neo family for being a part of it. Sales Mastery, there's the QR code. Hit it now. It was interesting. We were talking with somebody else a couple of weeks ago, and they on a different call, and they were like, "Hey, just so you know, the reason we ask for people to buy tickets now is less stressful for us. That's why we give you a better deal now. It's because less stressful for us, and we could pay deposits on speakers and hotel rooms and all kinds of stuff that we have to pay up front. And so it creates cash flow while there's no event. And I could tell you as an event promoter that all ticket sales happen 60 days out, and it drives us crazy. So as many of you that can join us that are committed to your success, committed to being part of the community, join us now, buy your ticket now. It helps us. It'll help you because we're giving away value every single month. We're giving away all this value add in our post ticket purchase campaign. We have calls that we're doing with Todd Duncan or Dale Vermillion or some of the best coaches that are already part of our ecosystem are coming on those calls to give you momentum leading up to the event, and the event is just where we gather. So there's our friend Todd. Todd's been an amazing partner so far, incredible couldn't be happier to have a coach and mentor by our side like that to build this event business together. So, any there we go. Kyle Draper's coming up soon. I don't know if you've seen Kyle or hung out with Kyle, but he's definitely got a great energy, and I'm looking forward to that as well.